To be successful with money and wealth, you got to control the things that you can't control. Fees and cost, risk, your discipline. But I think most importantly, taxes. If you don't understand what's coming down the pike in regards to taxes, stick around for this show because we're going to break everything down for you of tax reform. Is it coming? Is it not? And how is that going to affect you? So stick around. Welcome to the show, everyone. Joe Anderson here, certified financial planner. I'm president of this company here, Pure Financial Advisors. In this show would not be the show that it is today without Big Al Clopine. He's sitting right over there. He's a CPA extraordinaire, and we need his help big time today because we're going to dive into taxes. And when it comes to tax reform, that's the big news. What's going to happen to us? Are we going to pay more taxes? Are we going to pay less? Is it just political rhetoric? Stick around. That is today's Financial Focus. It's been a long time since we've had any significant tax reform. 1986, Ronald Reagan came up with the Tax Simplification Act, and it was nothing close to simple. George Bush came around and then came up with ECTRA, or the Bush tax cuts. They were due to expire in 2010. Remember the fiscal cliff, right? They were going to revert back to where they were when he enacted the Bush tax cuts. And then now here we are in 2017 with a brand new administration. We have Republicans in the House and the Senate, and this man here is our president. So this year could be as good as any for significant tax reform, but what does that mean to you? To help us out, let's bring in the big man himself, Big Al Clopine. What has it been? About 30 years since any significant tax reform.
Yeah, you are right about that. And President Trump has simply stated he wants things to be simpler.
Simpler.
And he wants to improve the economy.
So we'll see if it works.
Yeah, we'll see if it works. That's exactly right.
But I think there's a lot of confusion, too, because it sounds great. Let's simplify the tax code. That's what Ronald Reagan tried to do. But he added another 10,000 pages to the code, right?
Right.
And so when you hear lower tax rates, I think all of us think, hey, that's great. We're going to pay a little bit less tax. But there's also another side of the coin here.
Yeah, you are right about that, Joe, and that really is going to be our focus today, is getting into the tax reform, what has been proposed by President Trump. And by the way, also our House GOP leaders last summer, a year ago, came up with their own plan. And so the Trump plan is now relatively close to the GOP plan. It's not identical, but we're going to talk a bit about both. And so today we'll focus on what are some of the potential changes, and these are potential changes. This is not law yet. This is more or less up for discussion and debate and so forth. So individual taxes, we'll get into estate taxes, business taxes, and I suppose I'll say it this way, in virtually any kind of tax reform, there are winners and losers, and we'll get into that. And Joe, that's, I think everyone's just assuming they're going to be paying lower taxes, but that's not necessarily the case.
Yeah, I guess it depends on what state that you live in, what your income bracket's going to be, what it is now, right? What it's going to be in the future, and then how does some of these different changes going to affect you? Because simplification is great, right? If we could just look at, filing our tax return on a postcard would be ideal. But if you look at it, here's kind of the changes is what he's proposing, right? He's shrinking the brackets. Right now we have a 10, a 15, 25, 28, 33, 35, and it gets fairly complicated. It'd be great if you could just take this postcard and do your taxes and send it in the mail and be good.
And Joe, this is the GOP last summer came up with this idea, having a postcard, 14 lines to fill out your taxes, and wouldn't it be great if we could do that, if we could actually have our taxes simple enough to be able to do it on a postcard. And of course, in this case, there still would have to be ancillary schedules, so it's not quite as simple as it would seem. But nevertheless, the idea for both President Trump and the GOP leadership is to make things more simple.
That'd be ideal.
It would.
Right, let's see.
So I guess the first thing is the rates. As you were alluding to, there's 7 brackets right now. They start at 10% and they go as high as 39.6. And so this is what we have right now. These are our current taxes. This is married filing joint. And now the proposed rates. We got 10% rate, 25% rate, and 35% rate. And essentially the 10% is replacing the 10 and 15, the 25 takes over for the 25 and 28, and the 35 through 39.6 kind of gets averaged to 35%. Now we have proposed taxable income levels. Now this is not cast in stone. In fact, the latest a press conference by the president where they actually didn't announce what those are. We got these from the Trump's campaign, so we don't exactly know what these are going to be, but we're guessing those levels where these rates kick in are roughly the same as what they are right now.
Right. If you look at that chart, it's just taking the 10 and 15 and calling it 10, 25, 28, calling it 25, and then the three top rates, right, 33, 35, 39.6. Let's just blend those rates as well and call it 35%. And then if we take a look at the single, right, it's just kind of cutting that in half. It's the same idea. 10 and 15% would be the 10%, 25, 28 would be 25, and so on. And then when we take a look at this 37,500, right now today, that's the top of the 15% tax bracket. The 112,000 is the top of the 28. So if you take a look at where you fall today, you can kind of get a good idea, if this goes through, of where you're going to fall in the future, right? But these are just the marginal rates on the federal side, right? You still have your state tax to pay. Al and I were filming this here in beautiful Southern California, where we have a hefty state tax. When it comes to state taxes, you can write that off as a deduction, but there's also going to be changes here as well when it comes to deductions and your standard deductions and when it comes to exemptions.
Yeah, and right off the bat, what President Trump is proposing is that the standard deduction roughly doubles. So right now it's just under $13,000. For a married couple, it would be $24,000. And for a single taxpayer, it's a little over $6,000. It would be about $12,000. So that's one change. In other words, and when you look at that, itemized deductions versus standard deductions, you always get to take the higher of the two. My itemized deductions, my standard deduction, which is higher? Well, the standard deduction under this plan would be higher, so less people would itemize. But a corollary to this is that there's no personal exemptions. And then not all of the itemized deductions would be deductible. In fact, mortgage interest and contributions under the Trump plan and the GOP plan, by the way, they're consistent, would still be deductible, but everything else would not. So we're talking about state taxes, medical expenses, property taxes, job expenses. None of these would be deductible under the current plan. So even though you think you may be in a lower bracket, Joe, and in some cases without the deductions, you may pay more tax.
Yeah, so you really have to take a focus on the rates plus the deduction. That equals your taxable income and then where you're going to fall. So it might help some people, it might hurt some people, you might just stay the status quo. We're going to dive in a lot more in a second. Don't go anywhere. Show's called Your Money, Your Wealth. We are just getting started with a bunch of tax talk. If you are bored as I am, have a cocktail. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. What we're talking about today is potential tax reform. It's been about 30 years since we had any significant changes in our overall tax system. And a lot of people are thinking maybe 2017 is the year. Before we dive into those details, let's see how you did on the true-false question.
All middle-class taxpayers will pay less income taxes under the Trump tax reform proposal. True or false, Joe? What do we know when it says all?
You say false.
You say false is right. That is false, and we talked about this last segment. The standard deduction will be raised up. In some cases, that doesn't help people that itemize. The exemptions will go away, so some people are going to have higher taxable income. And in some cases, your medical deductions aren't deductible, your state taxes aren't deductible. No, not all taxpayers. Some will actually pay more taxes. But I guess with that, Joe, we got a segment in our show that we like to call Countdown to Retirement. It's where you get asked a question that you have not yet heard. Let's see how you do.
Hey Joe, I just want to ask on the distribution form of my 401k. When I have the 401k that is split between tax 401 Roth and 401 deferred, how do I distribute them and make them split equally? I believe one's tax-free, one's not. I just need a little more information. Thank you.
All right, so the question is that she has a 401k plan, she has a Roth provision in the 401k plan, and pre-tax. So as we all know, if you put money pre-tax, it grows tax deferred, and when you pull the money out, it's going to be taxed at ordinary income rates. Now she also has a Roth provision, which is an after-tax contribution that will grow tax deferred, but when she pulls those dollars out, it's going to be tax-free. Here's basically what's going to happen. Here's the advice first. Once you retire, You just roll the Roth 401k component into a Roth IRA. You roll the standard 401k into a 401k plan. Then you can pick and choose basically how much money that you want to take from the Roth versus the 401k plan. It really depends. If you keep it in the plan, it really depends on the plan document. It could be pro rata. What that means is that, let's say it's half. 50% pre-tax, half 50% post-tax. If you take $10,000 out, half of it would be tax-free, half of it would be taxable. To cure all of that BS that you don't have to deal with, just roll it into a Roth 401k, into an IRA, and that will clean your life up pretty good.
It's as clear as mud, right? These rules are tricky. And when you're thinking about 401ks, there are after tax, which are most of them, right? You get a tax deduction, the money comes out taxable. But then in some cases, there's Roth provisions. Right? A Roth provision means you can have tax-free growth in your Roth IRA. It's usually a sub-account. It's actually a separate account. It's kept separate. And in some cases, you have after-tax money in a Roth. Now, that's the part that could be rolled directly into a Roth IRA, or your Roth IRA component can be rolled directly into an IRA. So a lot of choices. Joe?
And I think a lot of people mess this up, and I'm really glad she asked that question, because when it comes time to taking distribution, you have to take a look at what the tax consequences is going to be on that income. And you might be taking a distribution from a wrong account, and that might put you in a higher tax bracket, or you should be creating tax because you're in a lower tax bracket. That's why we talk so much about taxes, and with this tax reform, a lot of different moving parts here. So we want to educate you so you're ahead of the curve, so you know how to plan, because everything in life you got to start with the plan, set that plan into motion, and then if you do that, you're going to have a lot more money long term because you know what's going on. You're educated. So we talked a little bit about the tax rates when it comes to the federal for filers that are married and single. We talked about deductions, exemptions, itemized, and everything else in between. Now, look at this, Al, the repeal of the Medicare Surtax. So that's the net investment income tax, the additional 3.8% tax that you receive on any capital asset. So they're trying to repeal this as well, so that could save taxpayers money that have significant assets in a non-retirement account.
Yeah, that's true, Joe. And that came about when Obamacare, or the Affordable Care Act, came into law. It helped be able to pay for it,
right.
I guess is what I'm trying to say. So yeah, that's 3.8% extra tax on your passive type income, interest, dividends, capital gains. That's if you're married and your income's over $250,000 or single $200,000. Then there's an extra 0.9% Medicare tax for salaries. So that was one of President Trump's campaign promises, and that is on the chopping block, at least in his proposal.
And then you got AMT tax. You got alternative minimum tax that they would like to repeal. And so if you take a look at this map, you know, California, this is, again, where we're taping, Minnesota, Oregon, Ohio, New York. These states those are the most people that are affected with alternative minimum tax.
Yeah, without question.
So if you're living in New York, New Jersey, Connecticut, you know, D.C., California, Massachusetts, Maryland, Rhode Island, Oregon and Minnesota, right?
Yeah.
You're going to be happy if this happens. I think the other states is like, well, I don't know. I don't care. I don't even know what the heck you're talking about when it comes to alternative minimum tax. Please stop changing the channel.
Yeah, I know. I think we've lost most of our viewers.
Yeah, it's over. It's totally
But at any rate, just very basic. Alternative minimum tax is a separate way to compute income taxes. You got to compute it the regular way, and the alternative way, and whatever is higher, that's actually the tax that you pay. Now, states that have the highest income tax, California being one of them, is more taxpayers are subject to alternative minimum tax, because in the AMT world, alternative minimum tax is not deductible. So then another thing is the estate taxes. Trump would like to get rid of estate taxes altogether.
Right.
And right now, we know that what happens is if you pass away, the first $5,450,000 is exempt to your beneficiaries, and then anything above that, it's 40%. That's actually 2016 number. It's at 5,490 for 2017. President Trump would like to get rid of estate taxes, and of course that would help those that have big estates. But part of this is because sometimes companies, there's small businesses, and the kids, the beneficiaries are forced to sell when the parents pass away because they don't have enough money to pay the tax. So there is some justification for that.
So if you look at it, let's just call it $5.5 million. If you have an estate under $5.5 million, or if you're married, if it's under $11-12 million, it's a non-issue. But if you do have larger estates, just know that they're trying to repeal this death tax. So today, as it sits, $5.5 million roughly. If you have a $6 million estate. Well, now you're over that 5.5 million, so about $500,000 would be taxed at that 40% rate. But here's the biggest reform I think that's on the table when it comes to businesses. So corporate tax rates here in the U.S. were one of the highest, about 35%. Looking at reducing that, I think would add a lot of I guess, profitability for companies, then that could trickle down to everyone in between when it comes to company stock.
Well, that's right, Joe. And so they're talking about reducing the corporate tax from 35% to 15%. And not only that, the flow through, the small business, the S corporations, the LLCs, that would be taxed at 15% too. When you look at the larger corporations, there's C corporations, there's a lot of justification for that. The tax rate is high when you consider the corporation pays taxes on its profits, and then the shareholders get the money, they pay taxes again. So it's double taxed. On the small business side, that profit's only taxed once, so that's going to be much harder to get through, but that's what's desired. Now, I would say this, there's no question with lower corporate taxes, that would mean more corporate profits. The stock market would likely, all things being equal, would continue to go up.
Well, I mean, that's why you get this Trump bump right now. That is
right.
What we're seeing.
Because it's anticipating.
It's anticipating,
right?
because
sure.
if I'm going to reduce my taxes by half as a corporation, well, if I do nothing, what's that going to do? That's going to build more profitability in my overall company. The market looks at that, and they already see this coming potentially. Once it hits, or if it doesn't hit, you're going to see the market kind of zig or zag in whatever direction. So if you're having any problems understanding what the heck we're talking about today, not to worry. What we did put together, Big Al here did, is put together a white paper just to detail everything that we've talked about in regards to tax reform here in 2017. You can go to yourmoneyyourwealth.com. You can download that paper if you're so inclined to do so. So that is the details, the nitty-gritty of everything that we talked about. Just go to yourmoneyyourwealth.com. There's a white paper of everything we talked about. Hopefully you can enjoy that, read that, and then it might put you to sleep. All right, we got to take another break. We'll be back in just a second. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Mr. Alan Clopine hanging out here talking about the new tax reform that potentially could happen and potentially could not. We'll see what happens. We're going to wrap this show up here shortly, but before we do that, let's see how you did on this true-false question.
Trump's tax reform proposal calls for the highest earners to pay more than he proposed during the campaign. What do you think, Joe? Or you weren't even listening?
I have no idea.
Yes. The answer is true.
True. All right.
Because
I had a 50-50 shot there.
During his campaign, he said the highest rate would be 33%. Now it's up to 35, right? So anyway.
And we're at
that's
what
true.
today? 39.6.
39.6, yep.
So
39.6, he was going to reduce it to 33, now we're at 35. Who knows where we're going to actually end up? We'll have to see.
Yeah, stay tuned, stick around. We will be on the cutting edge of tax reform here at Your Money, Your Wealth. And there's winners and losers, Al, isn't there, when it comes to this proposal?
Yeah, there are, Joe. And I think as you look over here, if my arm were longer, I would actually get there. But the winners are going to be most taxpayers are going to be in a lower bracket, and certainly corporations, small businesses, they would be in lower brackets. And if you're wealthy, you'll be in a lower bracket, and there's no estate taxes. So all that sounds pretty good, but there are some losers, right? We'll take a look at here. So certain single taxpayers that make between maybe $100,000 and $200,000 may be actually in a higher bracket, or families with children because there's no exemptions, so those would go away. And then finally, seniors with high medical costs. Oh my gosh! So medical expenses would not be deductible. So you're in a long-term care facility paying no tax because of the high medical deductions. That would potentially go away.
Right, and the reason for this, right, is taking a look at, I guess, the losers is, well, if I have these deductions that I'm able to write off today, I'm not able to write them off, but my standard deduction is going to increase. So it's going to depend on the medical deduction that you're already taking to see if that increased itemized or the standard deduction is going to overcompensate. So, of course, this is very generalized, you know, so save the hate emails or send them to Alan Clopine.com.
I had nothing to do with the tax code.
So speaking of emails, let's see what you have to say. What questions do you got? Let's go to the email bag.
Okay, our very first one, Christopher San Marcos. Would reducing the rate on corporate income impact my retirement accounts that are heavily invested in stocks? Boy, that's a great question, Christopher, because theoretically lower taxes mean more corporate profits. Higher corporate profits means the companies are worth more, the valuations are higher, which means the stock market goes up and up and up. But Joe, some of this is already priced into the market as we sit here today.
Yeah, I mean, theoretically speaking, if there's lower taxes for corporations, like we talked about, well then if they did nothing, increase sales, if their sales stayed the same, the revenue stayed neutral, but they're paying less in tax, well, that's going to increase their bottom line. And so the market is fairly sophisticated. They're already taking a look and they're saying, you know what, there's going to be a 50-50 shot here that tax reform is going to happen. And most experts will probably say that they're going to attack the corporate rates first. Then they do the individual rates. And so that's why we've seen this Trump bump, if you will. But then everything is hinging on, you know, the health care bill. And if that passes, it doesn't pass, and so on and so forth. This is not a political show. I don't know how I got here. But to answer your question, yes, potentially it could go up, but it could blow up on you too. So I would not put all my eggs in stocks thinking that, hey, you know what, that's a speculation. You want to still be globally diversified. You want to have bonds. You want to have stocks. You want international stocks, and so on. Let's go to the next question.
So number 2 from Linda in Coronado. I'm a small business owner with 7 employees. Will the proposed tax cuts benefit me? And Linda, if it happens as it's being proposed right now, the corporate tax rates and even the small business rates would go down substantially, because as a small business owner, if you have an S corporation, LLC, you're probably paying individual income tax rates because these are flow-through entities. You pay taxes on the corporate profits. So highest rate 39.6, now it's going to 35, but wait a minute, small businesses might get a special 15% tax rate. So that could be a huge savings, as Mr. President Trump likes to say. So yeah, it could definitely help you.
Yeah, I mean, I guess to explain that is that, right, it's a flow through. So any profits from that business flows through to your overall tax return, and it's taxed at the individual rates. What they're proposing is that you're going to pay yourself a salary, but there's also profitability of that business. And a lot of small business owners then take that as what is called a dividend, right? And so that dividend is going to be taxed at a lot lower rate than ordinary income. People have been playing that game for a while as a very low salary, but paying themselves a very high dividend to avoid self-employment tax. It's probably going to make this issue a little bit bigger, because if I can get my profits at 15% versus 39.6, you know, there could be a lot of shifting and moving around in the corporate structures and what people are actually doing there. I think we got time, Al, for one more. Maybe it's a one-answer question, but let's go for it.
Okay, we actually get to all 3. Number 3 is Fred and Del Mar. If the death tax is repealed, will I need to revisit my estate plan? Fred, absolutely, because a lot of estate plans are somewhat factored into what estate taxes are. If there's no such thing as estate taxes, then you may not need to worry about some of these advanced trusts that you've set up, family limited partnerships, grats, all kinds of crazy things people do to be able to avoid estate taxes. They wouldn't necessarily apply anymore.
I would absolutely get your estate tax reviewed, because a lot of the estate taxes that the estate plans that we see have is what is called an AB provision. And basically what that does is really help a family avoid estate tax. But remember, the estate tax has been around for a very long time. It's been around since the Civil War. It was repealed back in, 2010, Al? And George Steinbrenner died that day. I wonder if the kids had anything to do with it. He didn't pay any estate tax. So just stay tuned. I wouldn't do anything crazy. I wouldn't do anything rash. I would just kind of play this thing out, just kind of take a look. And that's why this is a process. It's not like set in stone. There's things that are going to change over your lifetime. You just want to be educated and have the information that you need to make the right decisions today. That's what this show is all about. If you want to get more information about the tax reform that we talked about over the last half an hour, go to yourmoneyyourwealth.com, yourmoneyyourwealth.com, and that white paper will be right there for you so you can dive in and read all about it. Hey, thanks a lot for tuning in. We'll see you again next week. Big Al Clopine, that's him. He's the man.